Today, we will talk about growth at a reasonable price, GARP. Growth at a reasonable price is an equity investment strategy that combines aspects of growth and value investing to select individual stocks. GARP investors look for companies with consistent earnings growth above market levels but without extremely high valuations. This typically leads GARP investors to growth-oriented stocks with relatively low price/earnings (P/E) multiples in normal market conditions. GARP investing was popularized by Fidelity manager Peter Lynch and uses the price/earnings growth ratio as a benchmark. The PEG ratio shows the relationship between a company's P/E ratio and its expected earnings growth rate over the next several years. GARP investors seek stocks with a PEG of 1 or less, indicating reasonable prices based on expected earnings growth. Value investors aim to buy stocks at bargain prices with a margin of safety, meaning a larger chance of future profit and less risk. They do not buy into the efficient market hypothesis. Instead, they may perform a discounted cash flows analysis to determine a stock's intrinsic value. Examples of famous value investors include Warren Buffett. One way to utilize the GARP strategy is by investing in an index fund that applies the strategy, such as the S&P 500 GARP Index. The Invesco S&P 500 GARP ETF is one fund that tracks this index, investing in companies with consistent fundamental growth, reasonable valuation, solid financial strength, and strong earning power. This fund holds well-known stocks like Meta, Adobe, and Cigna and comes with a low expense ratio of 0.36%. Here are 5 key takeaways. 1. Growth at a reasonable price, GARP, combines growth and value investing attributes. 2. GARP investors focus on companies with earnings growth above market levels but without extremely high valuations. 3. GARP stocks are growth-orientated with relatively low price/earnings, P/E, multiples. 4. GARP investors typically use the price/earnings growth, PEG, ratio to make investment choices, seeking companies with a PEG of 1 or less. 5. Instead of selecting individual securities, investors can apply the GARP strategy through index funds that track the S&P 500 GARP Index. Hope this would help. Thanks for watching.